My accountant once told me about a client who spent 6 months researching which shade of blue to paint his rental property. 6 months! Meanwhile, his $300,000 sat in a savings account earning 0.5%. The paint choice? Probably added $50 to his monthly rent. The opportunity cost of that delay? About $18,000 in unrealized gains. This guy wasn't stupid. He ran a successful dental practice, but he confused activity with progress, research with action. And here's the thing that really gets me. When he finally invested that money, he put it into 5 different index funds at Fidelity. Took him 20 minutes. The decision he agonized over for half a year turned out to be the simplest one he'd make all decade. I see this pattern everywhere. People treat investing like it's supposed to be complicated. Like if it's not hard, they must be doing it wrong. So they read 17 articles about the difference between the S&P 500 and the total market index. They join forums where people argue about expense ratios that differ by 0.03%. They convince themselves that somewhere out there is the perfect combination of funds that will unlock some secret level of returns. And you know what the really twisted part is? The financial industry loves this. They love that you think it's complicated, because the more you think you need their expertise, the more they can charge you for it. So look, I'm gonna walk through what actually happens when you put $100,000 into 5 specific Fidelity index funds. Not the sanitized version where everything goes up and to the right, the real version, where you're gonna learn that the question isn't which 5 funds are best. The question is why you think you need 5 funds in the first place. And more importantly, what that choice reveals about how the investment industry has trained you to think about your own money. Here's what we're gonna do. I'm going to explain the actual math on 5 Fidelity index funds. Real numbers, real returns, real tax implications. Then I'm gonna show you the psychological game that's being played every time someone tells you that you need to diversify across multiple sector funds. Because here's the thing nobody tells you. Fidelity offers these funds for free, not because they're generous, but because they've figured out that free products are the best customer acquisition tool ever invented. And once you're in their ecosystem, holding 5 funds instead of 1, you're 5 times less likely to leave. It's not charity. It's systems thinking. Imagine you're standing in front of 5 buckets in your backyard during a rainstorm. Each bucket is positioned to catch water from a different part of your roof. The consumer staples bucket sits under the part of the roof that's most reliable. Steady drip, never stops, even in a light rain. That's your Fidelity MSCI Consumer Staples Fund, ticker FSTA. Companies like Procter & Gamble and Walmart. People buy toothpaste in a recession. They buy toothpaste in a boom. The bucket fills slowly, but it never tips over. Then you've got the consumer discretionary bucket. This one sits under the downspout that only really flows when it's pouring. When the economy is good, when people have extra cash, this bucket fills fast. That's FDIS. Amazon, Tesla, Home Depot. When housing is hot, Home Depot prints money. When housing crashes, people stop renovating. The bucket can fill to the brim in a good storm, but it can sit nearly empty for years. Healthcare bucket? That's FHLC. This one's positioned under the section of the roof that always has some water coming down, but it really flows when the demographic reality hits. And here's your first systems thinking moment. The healthcare bucket isn't filling because healthcare is a good business. It's filling because the American population is aging and old people consume a staggering amount of medical services. Eli Lilly, United Health Group, Johnson & Johnson. These companies don't need a good economy. They need an old population. And brother, do we have an old population? The tech bucket is where it gets interesting. FTEC. This bucket sits directly under the biggest downspout on your roof. When it rains, this thing overflows. Apple, Microsoft, Nvidia. From 2010 to 2020, tech returned an average of 18% a year. But here's what they don't tell you in those promotional videos. That downspout also collects all the debris. When there's a storm, there's chaos. The dot-com crash, that bucket got knocked over completely. 20,001 was brutal. 20,002 was worse. The survivors did fine. The losers went to zero. And finally, you've got the NASDAQ composite bucket, ONEQ. This is basically a bigger version of the tech bucket with some extra biotech and growth stocks thrown in. It's the same downspout, just positioned slightly differently. Now, here's where this metaphor does some heavy lifting. The question everyone asks is, which bucket should I put under which part of the roof? And that question reveals a fundamental misunderstanding of how this works. Because you don't control the weather. You're not making it rain. You're just trying to catch the water that falls from a roof you didn't build. In a storm you can't predict. In amounts you can't control. The only variables you actually control are how many buckets you put out, where you put them, and how often you check on them. Most people think they're being smart by putting out 5 buckets. Diversification, right? But here's the first escalation. If you look at the actual holdings of these funds, you're not diversifying nearly as much as you think. FTEC is 99% technology stocks. ONEQ is more than half technology stocks. You're basically putting 2 buckets right next to each other under the same downspout and calling it a strategy. Let me give you real numbers, because this is where it gets concrete. Let's say you take that $100,000 and split it evenly, $20,000 in each fund. You're feeling sophisticated. You've got staples, discretionary, healthcare, tech, and NASDAQ. You're covered, right? After 1 year, assuming historical average returns, your FSTA position is worth about $23,760. FDIS is at $24,220. FHLC sits at $22,100. FTEC is at $23,860. ONEQ is at $23,016. Your total portfolio, $117,000. You made $17,000. Not bad for doing absolutely nothing. But here's the thing that bothers me. You didn't need 5 funds to get that return. If you'd put all 100,000 into a simple S&P 500 index fund, you'd probably be sitting at around 115,000. So the extra 2,000, that's your reward for picking the right sector tilts, 2% better. Over 1 year, now let's escalate this. Fast forward 10 years. Your FSTA position is now worth about $48,740. FDIS is at $63,180. FHLC is at $56,660. FTEC exploded to $117,300. ONEQ is at $80,300. Your total? $366,170. You more than tripled your money. Sounds great until you realize that a simple S&P 500 index would have gotten you to about $270,000. So you beat it by roughly $90,000. That's your reward for the complexity. And here's the psychological trap. That $90,000 feels like proof you made the right decision. You correctly identified that tech would outperform. You're a genius. Except you're not. Because here's what actually happened. You got lucky that the 10-year period you chose happened to be a historically unprecedented tech boom. From 2016 to 2026, technology companies benefited from near zero interest rates, a pandemic that forced everyone online, and an AI revolution that made NVIDIA the most valuable company on earth for a minute there. You didn't predict that. You caught a wave. And the dangerous part? You now think you can do it again. Let me tell you a story that illustrates this perfectly. I know a guy, let's call him Marcus, who started investing seriously in 2005. He was 32 years old, had just sold a small software business, and walked away with $200,000. He did exactly what every finance blog told him to do, diversified across sector index funds. He was heavy in financials because that's what was hot. Banks, insurance companies, real estate investment trusts. The logic was bulletproof. Everyone needs financial services. It's the backbone of capitalism. 2008 happened. His financial sector funds dropped 60%. 60! Meanwhile, his small position in consumer staples barely moved. his tech holdings got cut in half. By March of 2009, his $200,000 was worth $87,000. He'd lost more than half his net worth in 18 months. And here's the kicker. He sold. He capitulated. Moved everything into bonds and cash. He'd learned his lesson about taking risk. If he'd held on, if he'd just done nothing, that $87,000 would be worth about $900,000 today. But he didn't. Because the psychological pain of watching it drop day after day was too much. And this is the thing they don't tell you. When they show you those compound return charts, the returns are real, but your ability to actually capture them is entirely dependent on your ability to do nothing while watching your account balance crater. The third escalation is about taxes. And this is where I really start to get annoyed with how this stuff is explained. Let's say you're holding these 5 funds in a taxable brokerage account. Every year, each fund pays out dividends. FSTA yields about 2.4%. FHLC yields 1.3%. FTEC yields 0.7%. These dividends are taxable in the year you receive them, even if you reinvest them. On a $100,000 portfolio, you're getting somewhere around $1,000 to $1,500 in dividends per year. At a 15% qualified dividend tax rate, you're paying roughly $150 to $225 in taxes annually. Over 20 years, that's $3,000 to $4,500 in tax drag. And that's before we talk about what happens when you eventually sell. Now, you might be thinking, okay, that's not that bad. A few thousand in taxes over 20 years? I can live with that. But here's where the system reveals itself. Fidelity offers these index funds with expense ratios of basically zero. FTEC charges 0.08%. FSTA charges 0.08%. On $100,000, that's $80 a year. They're practically free. So why does Fidelity offer them? Here's what my fiscal lawyer explained to me. The funds themselves aren't the product. You are. Fidelity makes money by getting you into their ecosystem. Once you have 5 funds with them, you're not leaving. The switching costs are too high. The psychological burden of moving 5 positions, potentially triggering taxable events, dealing with paperwork, nobody does it. And once you're in the ecosystem, Fidelity can sell you other stuff. The managed account services that charge 0.3%. The financial planning that pushes you toward their higher fee actively managed funds. The margin lending when you want to buy a car but don't want to sell your positions. The funds are the loss leader. You're the long-term monetization strategy. And the beautiful part, from their perspective, is that you think you're being savvy by choosing index funds over actively managed funds. You think you're avoiding the fees, but you're not. You're just paying them in a different form. Here's the fourth escalation, and this is where we get into the real psychology of money. The reason people choose 5 funds instead of 1 has almost nothing to do with returns. It's about the illusion of control. When you split your money across 5 buckets, you feel like you're making decisions. You're an active participant. You're not just some passive schmuck who bought an S&P 500 fund and went to sleep. But here's the thing. That feeling of control is precisely what leads to worse outcomes, because now you're checking 5 funds instead of 1. You're seeing that FTEC is up 15%, while FSTA is only up 4%. And your brain starts doing this thing where it thinks, I should move money from the slow bucket to the fast bucket. I should rebalance. I should do something. And that something, that's usually the mistake. Because by the time you notice that tech is outperforming staples, that information is already priced in. You're not being clever by chasing performance. You're being human. And being human in investing is usually expensive. Let me show you the concrete 20-year scenario, because this is where the math gets real. You invest $100,000 today across these 5 funds, $20,000 each. You never add another dollar. You just let it compound. After 20 years, assuming historical average returns, FSTA grows to $136,200, FDIS grows to $199,000, FHLC grows to $186,260, FTEC grows to 315,440. ONEQ grows to 315,468. Your total portfolio is worth 1,152,368. You turned 100,000 into 1.15 million. That's an 11.5x return. Over 20 years, you averaged about 12.8% annual returns. Now here's what nobody tells you. That 1.15 million isn't money you have. It's money on paper. The second you go to access it, you're paying capital gains tax. At federal long-term capital gains rates, you're paying 15 to 20% on your $952,000 in gains. That's $143,000 to $190,000 in taxes. Your real spendable wealth, somewhere between $962,000 and $1,009,000. Still good, still life-changing, but not what the headline promised. And this is the thing that drives me crazy about how investing is marketed. They show you the gross numbers because the gross numbers are sexy. 1.15 million sounds way better than 962,000, but the 962,000 is the actual amount of money you have to spend. The rest is the government's, they were your partner the whole time, you just didn't see them on the cap table. Here's a mini case study that pulls this all together. Let's say you're 40 years old right now. You've got 100,000 to invest. You're trying to decide between going simple with one total market fund or getting sophisticated with 5 sector funds. Scenario A, you put 100,000 into VT1, Vanguard's total market index. You forget about it. You check it once a year, maybe. By the time you're 60, it's worth roughly 650,000. Simple, boring, effective. Scenario B, you split it across 5 Fidelity sector funds. You check them quarterly. You read articles about which sectors are poised to outperform. You rebalance once a year. By the time you're 60, you've got that 1.15 million we calculated earlier. But here's what it cost you. Roughly 40 hours of your time over 20 years researching and managing. Your stress level was higher during downturns because you were watching 5 things crash instead of 1. And you made 3 rebalancing mistakes where you sold low and bought high because you're human and humans are bad at timing. After accounting for those mistakes, your actual return is probably closer to 900,000. You beat the simple strategy by 250,000 over 20 years. That's 12,500 per year. Is that worth the cognitive overhead? Maybe, maybe not. Depends on how much you value not thinking about your investments. I'll give you a quick cutaway here. There's a scene in The Big Short where Mark Baum is touring Florida looking at empty homes during the housing crisis, and he realizes the whole thing is fraud. That's kind of how I feel every time I see a YouTube video promising to turn 100,000 into 10 million using index funds. Like, the math is technically possible if you cherry pick the time period and assume perfect execution and ignore taxes and fees. But it's not real. It's a theoretical exercise dressed up as financial advice. Here's the second cutaway. Fidelity's marketing team deserves a bonus because they've convinced an entire generation of investors that having 0 expense ratio funds makes them the good guys. Meanwhile, they're making billions on payment for order flow from your trades, securities lending from your long positions, and cash sweep programs that pay you 0.01% while they lend that money out at 5%. The funds are free. The ecosystem is expensive. It's the razor and blades model. Except instead of selling you blades, they're selling you a lifestyle of financial sophistication that keeps you engaged with their platform. Now look, I'm not saying don't use Fidelity. I'm not saying don't use index funds. I have multiple hundreds of thousands invested in index funds myself. What I'm saying is understand the game that's being played. Understand that when someone shows you 5 funds and says, these are the best, what they really mean is these are the 5 that fit a narrative structure that keeps you watching this video. Because if the answer was just buy VTI and chill for 30 years, this would be a 30-second video and nobody would watch it. So here's what actually matters if you're sitting on $100,000 right now. First, pick the simplest structure you can tolerate psychologically. If you need to feel like you're doing something, fine. Use 3 funds: total market, international, bonds. That's it. If you can handle the simplicity, use 1 fund: total world stock. Done. The difference in returns between those strategies over 30 years is going to be way less than the difference caused by your behavior during a crash. Second, the real alpha isn't in fund selection. It's in contribution rate and time horizon. Someone who invests $50,000 today and adds $5,000 per year for 20 years will end up with more than someone who invests $100,000 today and adds nothing. The math is boring, but it's true. Consistency beats timing, always. Third, tax location matters more than fund selection. If you're investing in a taxable account, use tax-efficient funds. If you're investing in a 401k or IRA, you can be more aggressive with less efficient funds because the tax shelter protects you. I see people obsess over expense ratios while completely ignoring that they're holding dividend-paying funds in taxable accounts. That's like buying an electric car to save gas money, but leaving it plugged in 24/7. You're optimizing the wrong variable. The real secret, the thing nobody wants to admit because it doesn't make for good content, is this. Investing $100,000 into index funds isn't going to make you rich. What makes you rich is investing $100,000, then another $100,000, then another $100,000 over a period of decades, while resisting the urge to do anything clever. The money doesn't come from picking the right funds. The money comes from consistently feeding the machine while everyone around you is panicking. Lazy investing built more fortune than crypto memes, leverage plays, or sophisticated sector rotation strategies. You know why? Because lazy investing is actually just discipline disguised as apathy. It's the recognition that the game isn't won by being smart. It's won by not being stupid consistently over very long periods of time. And the stupidest thing you can do is convince yourself that you're smart enough to beat a system designed by people with more information, better tools, and billions of dollars in resources. So yeah, take your $100,000, put it in FTEC, FSTA, FHLC, FDIS, and ONEQ if that makes you feel sophisticated. $20,000 in each. Set up automatic dividend reinvestment. Then close the app and go live your life. Check it once a year. Don't rebalance unless something catastrophic happens. And remember, the goal isn't to have the perfect portfolio. The goal is to have a portfolio that's good enough that you can ignore it while it does the only thing it's designed to do: grow slowly, compound reliably, and keep you from making emotional decisions with your money. That's it. That's the whole game. Anyone who tells you it's more complicated than that is selling you something.